I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim, and I hope you're nice and warm there in the southern states where a cold wave has swept through. Did it hit you?
The cold wave hit us, but we've had none of the snow or ice. It's just clear and cold, and I like it. Very nice weather.
Nice little change.
Yes, nice and crisp, and bluebird days, and not a cloud in the sky.
Well, speaking of cooling off, any sign of the equity markets bubbling out and crashing?
No, I think we're in full bubble mode, and we have been since November when we lost. I say lost when the last attempted setup with the DNA markers was blown out. I knew then pretty much we went into bubble mode, and that's where we're at with equities. And what I wanted to try to do, Jim, is explain this bubble mania and the relationship with some of the longer term cycles in gold and commodities and the CRB and how it fits in with the bubble and where we're going in equities, I think.
Now, of course, we've seen record highs in the Dow set almost daily. How long can this insanity continue?
Well, it's not over. It's not over. If we could, let's start with equities. In 2015, this market was, we were dealing with an extended 4-year cycle advance. I mean, that's just a fact. I mean, if you go back to 1896 and you look at all the 4-year cycles, it's obvious that they're in, it's a 4-year cycle in the market, and it ebbs and flows, and you can see it, and it has some statistical norms, and it's been pretty much like clockwork, with an average of 48 months and some change since 1896. And, we have ways of identifying that cycle, and it's there. I mean, it's no different than going and getting, it's not as scientific, obviously. It's not as carved in stone, but it's kind of like, a blood test or a diagnostic on your car or whatever. I mean, it's data, and it tells you something. And so you have these statistical norms. But of course the problem is cycles can contract, they can expand, and they can be distorted because of, market conditions and manipulation and a number of factors. So those aren't excuses. It is what it is. But as we moved into 2015, we finally got a little setup for the 4-year cycle top, and then we got this little weak decline into a 4-year cycle low in late 15, was in August of 15 on the industrials. It was in January or February, depending on what index you're looking at and everything else of 16. And then throughout 16, the market, it never reversed that previously triggered primary bearish trend change. It looked like there was more decline down, but the market would never give it up, and it just kind of churned all year. And then finally, I think it was in November, maybe in early December, a primary bullish trend change was triggered. And then the market started ramping up. But then in 17, what we saw was we'd see the DNA markers try to appear. You see one or two or three of them, it'd appear, and then they'd morph away, and then they'd appear, and then they'd morph away, and then they'd appear, and it's just like kept kicking the can down the road, nothing ever stuck. Well, that takes us to November of 16. We lost the last markers, and then looking at the interaction, which I want to try to explain with the other cycles, we went into full bubble mode. And there is no question in my mind. I have some data I'm going to show in the February research letter showing, going back to 1800, stock prices back to 1800, that this is the biggest bubble ever. And that's a fact. There's no denying it. I mean, people can look at it from evaluation methods, that John Hussman and different ones look at, and there's others. I'll just quote him. But regardless of whether you look at it from a technical perspective, a statistical perspective, or from fundamental value evaluations, it's a bubble. And it's, looking at what I'm looking at, it's not over. I think that there may be, some pullbacks, some smaller term or even intermediate term cycle tops that could give us a little bit of a pullback. But looking at what I'm seeing, it's not over yet. It has a green light for a while longer. And if we can, I'd like to talk about, commodities and the dollar and gold and how that relates, and then kind of try to tie that together if we could.
And we'll do that, Tim, right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, you said you were going to talk about the dollar and commodities. What's the connection?
Well, there is, within a market, there's, like I said, there's cycles of varying degrees, and it's like the old Dow theorist explained. They said you have, different, how do you say it? Different, I guess, levels of movement. And they explained it in terms of where you have, the tide, and then you have the waves, and then you have the little eddy currents and so forth. And so you have movements within movements, if you will. And it's the same thing looking at it from a cyclical perspective, which actually makes a lot more sense. But with the dollar, the dominant long-term cycle, there's a 4-year cycle, and you can quantify it. And historically, it's averaged about 45 months. It last bottom, I think it was in May of 2014, if I remember right. And now we're moving into the window for that low now, this year. Within the context of the timing for that low, there's an annual cycle low, and that the higher degree 4-year cycle low is going to bottom with this annual degree cycle low as well. So last September, we had the low of annual degree in the dollar, which, was close enough. That was month 40 of a cycle. This average is 45 months. So, that's close. You're within 5 months of a 45-month cycle. So it could be that was the 4-year cycle low in the dollar. And as it turns out, it wasn't. We knew that it was either going to be that low or there would be one more push down, which would actually make it possibly a little bit longer than the 45 months. And I think that that's where we're headed. I think the dollar, the 4-year cycle low in the dollar, we violated the September low recently. And the dollar's making another push down into that 4-year cycle low. And so, to put that in perspective, what I'm trying to say is that, yes, the dollar, is going to ebb and flow. Actually, we're moving into a little intermediate term low now, but the dollar is going to ebb and flow, up and down. But overall, we're pushing into that 4-year cycle low that is due, ideally sometime this year and, say June-ish, let's call it. And, that can change a little bit, but sometime mid-year we're looking for a major low in the dollar. So that's brewing. That's kind of setting the stage in the background there. At the same time, what is happening is that we've known that the 3-year cycle low in commodities bottomed in January of 2016. We know, based on statistics, that cycle has had an average of, I think it's like, I'm saying it off the top of my head. I didn't write it down, but I want to say it's like 38 months or something like that. And so we know that cycle is ideally due in late 18 to early 19 time frame. We know that we had one of the little annual cycle lows earlier this year. I think it was in June in the CRB and the commodity complex, and everything has advanced out of that low and pushing into the 3-year cycle top. But it's not there yet. You know, it's continuing to push. And yes, commodities have pushed a little longer than anticipated, and the dollar didn't, you know, look at the picture, connect the dots, and the dollar didn't make that 4-year cycle low. It's making that one more push down as commodity complex is lingering and continuing to push into the 3-year cycle top. So I'm not saying things turn on a dime, because they don't, but the general direction, if you will, is that commodities are pushing into a top. They'll reverse out of that 3-year cycle top in the general time frame as the 4-year cycle low, and the dollar is occurring, and then the dollar rallies out of that low. Well, in the meantime, because commodities haven't topped, and because there are some correlations there as well, but because the dollar hasn't bottomed and commodities haven't topped, equities have gone into, like I said, a full bubble mode, and have been since November. And again, I think that they're going to continue probably to do that until we get that bottom in the dollar, and until we see the top in commodities. Moving on with gold, to connect some dots there, you know, the question has been all along, there's been a lot of the gold bugs have said, you know, with 2015, so far that was the low point for the decline out of the 2011 high, and a lot of people have wanted to say that was a 9-year cycle low. Well, careful what you wish for. And because, you know, that's the worst thing that we could see for gold. Number one, that doesn't fit historically. One hard, fast rule that we have seen, or pattern, if you will, is probably a better word, is that within that 9-year cycle, there has always been 9 of these little annual cycles within what I call the 9-year cycle. That the overall so-called 9-year cycle in my world is typically averaged closer to 8 and some change, but because it's always had these 9 cycles embedded in it, I've referred to it as a 9-year cycle. Well, a lot of people have been optimistic about gold, and they've wanted to try to say and argue that the 2015 low was the 9-year cycle low. The problem is there was only 7 of these little annual cycles down. So obviously that means one of two things. Either we've seen something we've never ever seen before when we only had 7 of these cycles down, and there's no way to squeeze 8 out of it. And even if you look at it from a timing perspective, it's just far too short to have been ideal. So either we've seen something that we've never seen before, or the 9-year cycle low still lies ahead. And we can't really prove that yet, because we're just now in the 9th season, little annual cycle within the 9-year cycle. So we have to see where it proves that this annual cycle low occurs. If it occurs at a level above the 15 low, then it's going to force the 15 low to having been the 9-year cycle low, an oddball 9-year cycle low that we've never ever seen before, because it only had 7 of these cycles, smaller degree cycles in it. And people say, "Oh, hooray! That's great! That's bullish! I told you so! That's good for gold! We got the 9-year low." No. That is not a good thing. You're telling me we had a 9-year cycle low in December of 15, and this is it? We're now, we would at that point be 3 of these annual cycles through this thing, and this is it. The performance is pathetic. And if you go back and look at it, there has never been, I looked at another little statistic, there has never been one of these annual cycles that failed to move above a previous, I know this is getting a little bit technical, probably hard to follow in your mind, but we had what we call a failure of this last little advance up this last summer, in that it didn't go above the previous high in 2016. Well, anytime that's ever happened, that's been bearish for gold. And so the most bullish thing that could happen for gold is for us to get the washout into that 9-year cycle low ahead of us. And so that's another piece of the puzzle that we're trying to, we have to see the data. The market needs to confirm itself and let us know, yes, the 15 low, we did see an oddball low, and the 15 low was in the 9-year low, or no, it wasn't, and we get the washout. We need to get the confirmation there. We need to get this 4-year cycle low in the dollar in place, and we need to see the 3-year cycle top in the CRB. And so what I'm saying is, as we move into 2018, we have all these transitions happening. All these things are going on, ahead of us with these cycles topping and bottoming. At the same time, there is nothing in place on equities to stop the bubble. Like I said, everything, the can got kicked down the road throughout 2016 and into 17, and there were warnings everywhere, and the market was actually on edge a number of times. I think we had 5 or 6 Dow theory non-confirmations, but they never stuck. They never were solidified with an actual primary bearish trend change, but at the same time, the warning was there, but like I said, nothing ever happened. Well, now we have nothing. And so we're in full bubble mode, I think. What I think is happening is that everything is ramping up together. Commodities are pushing up into the top. Equities are pushing up into the top. I think everything is going into a major top, and then we ultimately see these cycle tops and bottoms that I'm talking about set up and form, and then we should see the DNA markers fall in place in equities, and things will roll. Once it happens, Jim, I think it's obviously blown into an even bigger bubble than I imagined. I mean, it's the damnedest thing I've ever seen. It's like I said, looking back to 1896 by some measures, technical measures, or 1800 actually. Looking at the new data that I got, it's the biggest bubble in history. And then looking at valuation methods and other methods, those guys are coming up with the same thing. So, for us people that are talking about the bubble, we're not crazy. We're measuring this thing, but at the same time, there's nothing here yet to stop it.
We'll have more with Tim Cyclesman Wood right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Tim Cyclesman Wood. Tim, the psychology out there, I've been told, has changed from TINA to FOMA. In other words, from there is nothing else to invest in except the equity market to now fear of missing out.
Yeah, and I think that's a sign of it. And some people might accuse me. They say, well, what's changed? Here you are turning bullish. No, I'm not turning bullish. I'm scared to death of this thing. I know how it's going to end. My overall view is that it is an even worse disaster in the making than I thought. I mean, before the election, and I've saved the video. I know exactly what the quote was, or quotes, because there's more than one, of even, Trump, like him or hate him, he acknowledged that it was the bubble that it is. I mean, so, of course, he's not talking about that now. He's wanting to take credit for it. But my point is that people know. Other people want to deny that it's a bubble. Some people, I got into a little bit of a conversation with a guy, and he said, no, you're confusing prosperity with, you hadn't seen prosperity in so long, you don't realize what it looks like. And I'm just shaking my head, hearing what this guy is saying, because it's an illusion. This is, like I said, I don't mean to beat a dead horse, but this is the biggest bubble in history. I mean, looking at stock prices going back to 1800. And so, yes, I see that too. The fear of missing out, that's part of the mania. And, the thing that has changed from last year and into 2000 and even 2016 is that there were warnings of a top of the bubble then. There were. I mean, you had DNA, the stuff would fall in place, it'd never stick, but the fact that it was occurring, it would try to stick. I mean, excuse me, that's the wrong word. It would try, you would see it fall in place where the opportunity for something to stick would be there, but then it just never would. Well, now we're not even seeing that. And so what I'm saying is that it's just full mania. And that said, I want to be clear. There are some intermediate term, there absolutely is an intermediate term top due here and now and a low due, next month. But, do we even see the pullback into that? I don't know. If we do, it's not the top. This thing is not over. It's not over.
Tim, now, it's not going to be a discussion about cyber currency, but we saw Bitcoin and other cyber currencies or cryptocurrencies drop more than 50% in value. Could the same thing happen to the stock market?
The same thing is going to happen to the stock market. That's the dangerous thing about this, is that no one, it's like the comment that the guy made. He said, this is, prosperity, and you've forgotten what it looked like. That's the most asinine statement I've ever heard. Because if you go to the actual, I forget what it's called. I've got it bookmarked, and I monitor the data every once in a while. But if you go to the actual St. Louis Fed and you look at the velocity of money, the rate of the turnover of money, looking at that going back to, I think that goes back into the 50s. It's at the lowest level. I can't remember, but it's at an extremely low level, and it has not picked up. If you look at the job participation rate chart, I know we've talked about that before, it's back to the 1970s levels. And so, no, it is an illusion of prosperity. And what I was trying to say, I don't know if I got it out. I may have confused people with those, with talking about the cycles, but here's the point in what I'm trying to make, is that the dollar is moving into a very, very important 4-year cycle low. Now, what it does with that low, I don't know, but it should be when I say what it does, I don't know. It's going to be a bottom, and the dollar's obviously going to rally out of that 4-year cycle low. And at the same time, that's going to be a pivot point. It's all of the how do I say this? The roads are pointing to that same juncture in time as the dollar is bottoming. Equities is pushing up into this top. Commodities are pushing up into a top. And then, the thing about gold is, does gold crack here and go down into the 9-year cycle low, which would coincide perfectly with that timing if it did, and then gold explodes out of that 9-year cycle low while everything else is collapsing? That's scenario one. Or if the 9-year cycle low happened to have been forced with that oddball low in 2015, then what it would mean is that gold is also pushing into a 9-year cycle top. And along with the 3-year cycle and the CRB and the rest of the commodity complex, oil and the rest of it, and as the dollar bottoms, then everything would be set up to collapse together. Everything, every asset. That is the worst scenario. And I know that sounds crazy, but it's one or the other, and all of the data is not there yet to know. We're going to see this set up. I will see it. We should see the signs. The structure of the market should tell us as we progress here. And I think gold, determining where that 9-year cycle low was in gold, is going to be a big piece of that puzzle. And so, no, it's far worse than I imagined. But so I don't mean to sound like I'm talking out of the same sides of my mouth, or all of a sudden I've taken a different stance. No, that's not it at all. The data has changed somewhat in the interim. But at the same time, it's become obvious that it's even a bigger bubble than Trump talked about in 2015, 16 before the election. It's even a bigger bubble than I imagined. And, the data is now telling us that it's not over, and that we potentially, depending on, like I said, how those cycles interact, are setting up for a complete, I hate to use the word, but I mean, that's what it's telling us, collapse of all asset prices.
Well, Donald Trump took credit for the big rise in the stock market. Will he take the blame if it dives?
He's not going to want to take blame, but one of the biggest mistakes I don't like to play the politics side. I don't, I hate to go there, but, one of the dumbest things he did was take credit for that. He should have distanced himself from the market. Why would you sit there and talk about it being a bubble prior to the election, and then once you're in office, take credit for it? That was a big mistake in my opinion, because of course now he owns it. He owned it. And so when this comes apart, of course, he may try not to take credit for it, but he owned it. It's his. And so, I don't see how this Jim can stay together, for the remainder of his, it is extended far beyond anything, most any of us have ever imagined was possible, but I just don't see how this is going to stay together through his term. And, it comes unraveled. He's done, man. It's like Bill Clinton said, it's the economy, stupid, and you let this thing come apart, you bet he's going to own it, and he's going to regret that.
Tim, thank you so much for chatting with us.
Thank you. I hope that wasn't very confusing, but it's the interaction with the cycles it's kind of hard to draw that picture in someone's mind. And, guys, I'm covering that in the letter. This is a fascinating setup in time that we're experiencing here. 2015-16 or 16-17 was very, very confusing and frustrating, because it was like operating in a fog. We had these mixed signals. And, now, it is what it is, but now, the fog is lifted and you can see what's going on. Now we got to figure out, is it variety A or variety B, scenario A or B. And I've been saying that basically what it boils down to is are we somewhere in 1928? Or are we somewhere in 1929? It's like, which one? Where are we in this bubble? And that's the pieces of the puzzle that we're putting together now. But it's not over. And I'm telling you, this is it ultimately is going to be even worse than I imagined. But anyway, that all said, I'm kind of repeating myself, but I've talked about it. This last letter, I've talked about it and laid it out. I usually don't push the letter, but if you're interested in that, please take a look at that data, and that's going to be our focus in 2018, and gold is a big piece of that. So, that's going to, like I said, that's going to be our focus in determining on, where these cycles are and what's going on with the bigger picture and how it fits.
Well, Tim, it sounds like all these cycles are coming together like the rogue wave that sank the Edmund Fitzgerald that Gordon Lightfoot sang about.
Well, yeah, things, sometimes when you look back at data, and sometimes people say, well, when the dollar goes up, this goes down, or when this goes down, this goes up, and then you look back at other times and go, well, it didn't do it then. And the thing is that it depends on the cycle. Where are these cycles topping and bottoming? Sometimes they're in sync, and sometimes, they're in opposition. And so right now, we have that juncture. We're coming to that juncture. And that's what's fascinating about this, is that we have none of the markers in place in equities. We're in full blow-off mode. And then we have this juncture ahead of us, and it's like Dick Tracy. We have this piece with gold, and once we get clarification on that 9-year cycle thing on gold, and we get clarification on where the commodity top, yes, it's lasted longer than we thought, but it's still pushing into that 3-year cycle top. And then once we get clarification on that, we're going to have a pretty clear picture of this. And ultimately, like I said, it's just a matter of time or timing on the bubble, but this is it's not what it appears, people.
Tim, thanks again.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. If you have any questions for the show or our guests like Tim, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.